The money sitting in your bank account isn't actually there. That's not exaggeration, it's not clickbait, and it's not some fringe theory. If everyone with a bank account showed up tomorrow morning and demanded their cash, the entire financial system would break within hours, not because people panicked, but because the money physically doesn't exist. And that's not a mistake. This is how the system was built. It's a design so old and so deeply woven into global finance that most people accept it without question. A mechanism that quietly fuels debt, inflation, and the illusion of wealth while convincing you that your balance equals value. It has a name: fractional banking. And once you understand how it works, you realize money isn't a stored asset, it's a promise that can never be fully fulfilled. To understand how we ended up here, we have to go back to a time before digital balances, before central banks, before nations could create currency with policy decisions, a time when money meant metal. In medieval Europe, wealth wasn't digits or paper, it was gold and silver. If you were rich, you didn't have a bank account. You had chests full of coins and jewels you could physically trade, but carrying gold was dangerous. Roads were violent, travel was slow, theft was common, so people began storing their valuables with goldsmiths' men who already owned strong vaults. In return, they received written certificates promising they could reclaim their gold whenever they wanted. Soon, those certificates became easier to trade than the metal itself. The receipt became the transaction, and that's where the shift happened. Goldsmiths realized people almost never came to retrieve their gold. Out of 100 depositors, maybe 1 or 2 would come back on any given day. The rest relied on the paper, so the gold stayed still. The paper moved, and temptation stepped in. They started issuing more certificates than gold in storage. If they held 1,000 coins, they might issue receipts totaling 2,000. The extra receipts were loaned out at interest-earning profit on money that didn't physically exist. As long as people didn't demand their gold at the same time, the deception held. This wasn't a minor trick. It changed the nature of money itself. Once people accepted pieces of paper as good as gold, money was no longer tied to metal. It was tied to belief. Banks didn't just store wealth, they started creating it. This shift didn't remain a private scheme for long. Governments eventually noticed how powerful this mechanism was, not just for profit, but for control. By the late 1600s, the idea evolved into institutions. In 1694, the Bank of England was created not as a public service, but as a solution to a government drowning in war debt. The crown needed money it didn't have, and lenders wanted a guaranteed return. So the bank extended loans far larger than the gold it held in exchange for interest paid through taxes. It wasn't treasure from conquered lands repaying the debt anymore. It was citizens. Sound familiar? It should. It's the same model used today. Governments borrow money that does physically exist and repay it with future taxes. Across the Atlantic, the United States followed the same pattern. Early American banks issued notes supposedly backed by gold, but they quickly realized they could create more notes than they had reserves to cover. It worked until people demanded their gold. Then the illusion cracked. Crowds lined up outside banks, panicked and outraged, demanding the money they believed was safely stored. But there wasn't enough to go around. Banks fell one after another. The response wasn't to abandon the system, it was to fortify it. Central banks were created not to ensure money existed, but to ensure confidence survived even when it didn't. The message became clear: as long as people believe the system works, it will. Now, let's bring this into the present. Because fractional banking isn't some dusty historical trick, it's operating right now in every major economy. Imagine depositing $100 at your bank. Most people think the bank holds that 100 on their behalf, ready to be withdrawn. In reality, only a tiny fraction stays in reserve. Historically, it might have been 10%, $10. The remaining 90 gets loaned out. Someone else spends that 90, a store deposits it into another bank. That bank keeps 9 and lends out 81. That process repeats over and over. By the end of the cycle, your original $100 has become nearly 1,000 circulating dollars, but only the first 10 existed as actual cash. The rest is debt, multiplying through the system. Money isn't printed, money is created through obligation. But here's the part that should concern you. What I just described is an old version. In the United States today, banks are not required to hold even 10% in reserve. Since March 2020, the required reserve ratio is 0. Not lower, not reduced, plain and simple. 0. Meaning, banks can legally lend out your entire deposit and keep nothing on hand to give you back. So the natural question becomes, if banks don't need reserves, what stops them from lending infinitely? The answer is something different entirely. Capital and liquidity requirements rules set by international regulators under the Basel framework, created after repeated financial crises. These rules weren't drafted by elected politicians. They were created in Basel, Switzerland, by central bankers behind closed doors, often called the central bank of central banks. Instead of limiting loans based on deposits, banks are now limited based on risk. For example, if a bank issues a risky $100 loan, it might be required to hold only $8 of its own capital as a safety buffer. If the asset is considered safe, the requirement might be even lower. Risk, not reserves, controls money creation. And on top of that, banks must prove they hold enough liquid assets like cash or government bonds to survive short-term crises. Not enough to repay everyone, but enough to prevent immediate collapse. But here's the key shift. Banks no longer lend from deposits. Loans come first. Deposits are created after the loan is issued. When you take a mortgage, the bank doesn't transfer money from someone else's account. It types new money into existence, backed only by your promise to repay. That's why more than 90% of money in circulation isn't cash from central banks. It's bank-created money born out of debt. Look at your checking account. Those numbers aren't stored notes. They're claims on future payments created when someone went into debt. And that's why financial crises are always crises of confidence. When borrowers can't repay, or when banks can't roll over debt, the system begins to unravel. This system produces three outcomes that are unavoidable, not flaws, not mistakes, but built-in consequences. First, inflation. Because banks multiply money faster than real value is created, purchasing power erodes over time. Prices rise not only because goods become scarce or demand increases, but because the currency itself stretches thinner with each new loan. Your money isn't losing value by accident. It loses value because the system requires constant expansion. Second, permanent debt. Since money enters circulation as a loan, the total debt in the system will always exceed the amount of money available to repay it. Add interest on top, and the gap widens even further. Someone must always owe, someone must always borrow again, someone must always fall behind. Third, consolidation of power. Banks earn interest on money they never physically possessed. Governments tap this same mechanism to finance wars, welfare, and bailouts without directly raising taxes. Meanwhile, the wealthy own assets that rise in value as the currency weakens, while workers paid in cash see their earning power evaporate. Those who own assets rise. Those who rely on wages sink. This system rewards ownership. It punishes saving. Every time confidence breaks, the illusion cracks. Look at the Great Depression. Banks issued credit far beyond their reserves, fueling speculation. When fear spread, depositors rushed to withdraw their savings. The money wasn't there. Banks collapsed by the thousands. Look at 2008. Banks layered debt on top of debt through mortgage-backed securities, creating a housing bubble that looked like prosperity but was built on leverage. When homeowners defaulted, everything fell apart. Once again, the real problem wasn't just bad loans, it was belief disappearing. And how did governments respond? Not by shrinking the system, but by injecting trillions to keep it alive. They bailed out banks with money created at the push of a button. Because without constant credit, the modern economy can't function. The financial system didn't collapse because the trick failed. It survived because the trick was rescued. Today, this design spans the entire planet. In the US, reserve requirements are gone. In Europe, Canada, Australia, and the UK, reserve rules had already faded into symbols long before. Lending is governed by risk ratings and Basel rules, not vault balances. Meanwhile, emerging markets China, India, Brazil, and others still enforce high reserve ratios, sometimes in double digits. They still limit lending growth using old-world mechanics. But even there, Basel rules sit above everything, shaping how much risk a bank is allowed to take, regardless of how much cash sits inside a vault. No matter where you live, the leash on money creation is not deposits. It's regulation, confidence, and the willingness of people to keep borrowing. And here's the part that affects you directly. This system cannot afford for everyone to be debt-free. If every household and business paid off their loans tomorrow, the money supply would collapse. Banks would have nothing left to lend, and economies would grind to a halt. Your debt doesn't just fund your goals, it fuels the entire machine. You are not just a customer of the system, you are the collateral. Your future labor backs the money being created today. The same mechanism medieval goldsmiths used to conjure wealth from nothing has been scaled up into a global financial architecture, and the same dangers remain. 19th century bank runs, 20th century depressions, 21st century financial crises. Different eras, same root cause, promises multiplied beyond reality. Confidence holding it all together, collapse following disbelief, and every time the response is identical. Patch the illusion. Restore confidence, move forward as if nothing happened. The world doesn't fix the flaw, it reinforces it. So what should you do with this information? First, understand that money is not wealth. Money measures value. It does not hold it. Real wealth is independent of belief. Land, energy, knowledge, skills, ownership, productive assets, resources that retain value when paper promises dissolve, digits can vanish. Value remains. Second, understand that debt is not neutral. It shapes who rises and who falls. Third, understand that inflation isn't a malfunction, it's a feature. It forces you to spend, borrow, and participate in a system that needs constant motion. Every year, you run faster just to stay in the same place. This doesn't mean collapse is guaranteed, but it does mean you must rethink your relationship with money. Saving cash won't protect you. Blind trust won't free you. Waiting for the system to change won't lift you out of it. Freedom comes from stepping outside the structure, not living deeper within it. History doesn't repeat exactly, but it rhymes loud enough for those who listen. From the vaults of medieval Europe, to the bank lines of 1929, to the mortgage bubbles of 2008, the pattern has always been the same. Promises multiply faster than reality until reality pushes back. The system doesn't rest on gold, or productivity, or even logic. It rests on belief, and belief is the easiest thing to lose. So the next time you check your bank balance, remember, you're not looking at stored value. You're looking at confidence. Understand the mechanism, and you can protect yourself from it. Ignore it, and you remain a player in a game where the rules were never designed for you to win. If this changed how you see money, subscribe. History has answers, and here we connect the dots.